Guys, welcome to this Money Control live stream. I'm Nandita Khemka and you're watching Opening Bell. It's a brand new week and major cues are out of the way for the markets. But yes, the situation when it comes to global tariffs, that is something that will keep the markets on tenterhooks. We had a troika of good news for the market. Budget, had announcements towards tax cuts, which will boost demand going forward. So that was one big positive. We had the RBI also taking forward the growth mantle, announcing a rate cut of 25 basis points for the first time in 5 years on Friday. Market had run up quite a bit in anticipation of that, so we didn't really see any kind of cheer on Friday, but we did end off the session lows rather. And Saturday we had the verdict from the Delhi polls where BJP is back in Delhi after a gap of 27 years. From a market standpoint, all these factors that I mentioned are positive, but which way we head from here, now that all the cues are out of the way, is something that all the traders will be keeping a close eye on. In terms of the GIFT Nifty this morning, hinting at a subdued start. Of course, we have the whole tariff thing playing out. Global markets aren't looking all that encouraging this morning, and looks like we are poised for a weakish start. But 23,400 on the downside, experts say, would be a crucial level to watch out for. On the upside, the recent swing high of 23,807, if that is crossed, who knows, we could make a dash at that 24,000 level on the upside as well. But of course, lots of stocks in focus, and your stock related queries will also be in focus. So keep them coming in on a live feed. We'll try and get them addressed by a technical expert on the show. But before we move any further, let's quickly take a look at the top stories at this hour. Wall Street closes lower on Friday as US President Trump threatens further tariffs on trading partners. Asian markets open lower this morning. The GIFT Nifty is also suggesting a weak start for the Indian market. Crude prices dip for the third straight week, with Brent trading around $75 a barrel. Gold prices meanwhile rise for the sixth straight week on increased safe haven demand as trade tensions escalate. Following the customary post-budget meet with the RBI Governor, Finance Minister Nirmala Sitharaman says the new income tax bill will be tabled in the Parliament this week. Speaking on the rupee, the Governor says the RBI will let market forces determine the level of the rupee and that the RBI will only manage excess volatility. And the BJP comes back to power in Delhi after 27 years, winning over 45 seats out of 70. The Aam Aadmi Party loses after a 10-year reign, winning only 23 seats. AAP leaders Arvind Kejriwal and Manish Sisodia also lose their incumbent seats. Well, on that note, let's take a look at the cues for trade. In fact, recap last week's action for you. It was a second straight week of gains for the market, although the gains were pretty slim because we saw 3 straight days of weakness coming in when it comes to the Lal Street. Pharma and metal gained the most last week. FMCG was the top losing index. In fact, it was under pressure for a fourth straight session on Friday. Markets of course ended in the red on Friday despite a 25 basis point rate cut, but the mid-cap index managed to buck that trend, ending marginally in the green on Friday. Federal Bank, REC, PFC, these were some of the stocks that rose from lows post RBI statement because they said that the expected credit loss and liquidity coverage ratio as well as provisioning for projects, these are some of the rules that will not come into force from 1st of April but next financial year. So that came as a reprieve for some of these stocks. Trent, that stock has been in the news. In fact, it has been one of the most headline-grabbing news stock rather, because it was a showstopper stock last year, but this year hasn't been all that great for this stock. Has seen a very volatile ride. In fact, the stock is or has given negative returns so far this year. So that stock, managed to end higher rather. The Nifty put call ratio was at 0.83 vis-a-vis 0.95 in the previous session. We just have one new entrant in the F&O ban list, Manappuram Finance. Most of the trading sessions last week, we didn't have any stocks in F&O ban. But foreign investors continue to remain net sellers. In fact, they've pulled out, somewhere around 7,300 crore rupees from Indian equities in the first week of February itself. January, remember, saw a 78,000 crore rupee outflow when it comes to foreign money, and the sell-off continues. But on in Friday's session rather, the sell figure was largely meager. 470 crore rupee worth of stock was sold in the cash market, but the FIIs also added positions when it comes to shorts in the index futures. So shorts were added. So that's not such a great news, because whenever we have extreme short positions in the futures and options market by the FIIs, we see some bit of short covering, but that was getting reversed. But once again, they've started adding shorts. Domestic investors, shorted stocks, in fact bought rather stocks worth 450 crore rupees in the cash market. But on that note, let me quickly bring on board our technical expert for today. Joining me is Nilesh Jain, of Centrum Broking. Then Nilesh, great to have you on the show. Major events out of the way, what are the support levels you'll be watching out for, given the fact that tariff uncertainty looms large? Expectations are that we could head lower from here. So if at all we are heading lower, what are the support levels to watch out for on the index?
Morning, Nandita. Yes, you rightly pointed out, we are heading lower. That clearly can be seen on the chart as well. For the third consecutive session, we have seen the market remain under pressure on Friday. If you look at on the upside, the resistance, which is currently placed at 23,800, that's the 50-day moving average, and that is acting as a stiff resistance zone. And we have seen multiple occasions Nifty made an attempt to cross the same but couldn't clear that particular level. Now on the lower side, we have multiple support as well. Even if you look at the derivative data, that shows that 23,400, 23,300, 23,200. These were the three strike on Friday where we have seen a fresh addition on the put side. So looking at the setup on technical as well as on derivative front, it looks like Nifty is likely to oscillate in the range of 23,200 to 20,800. That's the broader 600-point trading range. Purely from intraday point of view, looking at the pre-opening, it looks like we may see a flat to negative start. But I think there will be another round of selling which will take Nifty towards 23,450 to 20,400 zone going forward. So we are not out of the woods yet. Any pullback might get sold into. And it is advisable to stay cautious for the time being trading in the index, given the kind of setup we have seen recently. So we need a breakout about 23 to 20,800 to call it as a short-term base formation. As of now, it is merely a pullback. Similar with the case in the Bank Nifty as well. It has faced resistance at its 50 DMA, which is currently placed at 50,700. So a breakout of that will take Bank Nifty towards 51,000, and we need a breakout confirmation. As of now, from intraday point of view, looks like Bank Nifty is likely to oscillate in the range of 49,800 to 50,500. So it is advisable to focus on stocks rather than trading in the index. In the broader markets as well, we have seen some pain, although some pullback was seen, but the pain is not yet over, and we may see further downtick to continue. So it is better to focus on stocks and sectors.
Okay, better to focus on stocks and sectors. But which are the banking stocks you would look at now? SBI also came out with numbers. Asset quality was good, but margin pressure continues. So on the charts, how are you looking at SBI now, and any preference when it comes to the banking pack?
Right. So we have seen sort of a selling pressure in the State Bank of India post numbers as well. And we may see a follow-up more on the lower side, although there could be possibility of a pullback. But looking at the overall setup, which is not looking promising, 780 is the breakout zone. I would rather wait for a breakout above 780 before buying SBI or even recommending. But better to stay away for the time being within the PSU banking space. The structure is not looking clear. And going forward, if at all it breaks below 730, then pain will continue further towards 720 to 700 as well. But our preference is focus on private sector banks, counters like HDFC Bank, which is looking strong. And apart from that, for HDFC Bank, the target on the upside comes somewhere around 1760 to 1800, and support is at 1700. So buy on decline should be the strategy. Another preferable stock would be Kotak Mahindra Bank. Looks very strong on the chart. Friday, we have seen a good breakout as well from a big rounding bottom formation. So Kotak is a buy for the upside target of 1960 to 2000, and support is placed at 1880. So again, a buy and decline should be the strategy, can be bought at current level as well. But I think today's market volatility will give an opportunity to buy near about 1900. So these are the two private sector bank as of now. We are liking PSU banks are avoid for the time being.
Avoid PSU banks, and Nilesh is liking HDFC Bank and Kotak Mahindra Bank on the charts. But sticking to the BFSI space, let's talk about insurance. LIC, this stock has been under continued selling pressure. If you look at the long-term charts as well, 3 months, 6 months, all will indicate that it has given negative returns. It continues to remain sub 900 levels. Numbers came out post-market hours. LIC, the third quarter new business premium is down 21% on a YOY basis. Annual premium equivalent is down 24%. This is below expectations. The retail annual premium equivalent is down 27%. This is also below expectations. But the value of new business, that end has done well, even though, it is down 27%, but the street was working with lower figures. And even in terms of the BNB margin, it's at 19.5% almost vis-a-vis 26%, but the street was working with a lower figure. Anticipation was fairly low. But as I mentioned, the stock has been under continued selling pressure. Do you think it is now approaching its bottom, or do you think there is more downside left to it?
Well, it's very difficult to call it as a bottom because the trend is looking weak. The stock is in a corrective phase, constantly making a lower top and lower bottom formation. The stock although has a very good support at 801. So if it breaks below 801, then a further downward trend will resume and it may slip further towards 760 to 750 as well. But as of now, good part is that it has a very strong support. So from a risk and reward perspective, at current level, one can stay put or a contra bet can be taken, but a breakout is awaited. So I would rather wait for a breakout above 870 that will give a confirmation of a double bottom breakout. So 870 and 801, these are the kind of a goalpost we can say. Whichever side it will break, we can expect further move in that particular direction of 3 to 5%.
All right, that's the view on LIC, but if we're getting the first ticks then, opening bell, there goes the opening bell. The Nifty is down somewhere around 50 points or thereabouts, holding on to that 23,500 mark by the skin of its teeth. In fact, it has broken below that level as well. But mid-cap index is trying to edge back into the green. Remember in Friday's session as well, the mid-cap index was bucking the trend. Sensex is down somewhere around 200 points or thereabouts. The Nifty Bank index is also witnessing a triple-digit cut at the current juncture. So it is holding on to that 50,000 level. But whether or not it manages to do so as we progress throughout the day, that's something that we'll have to watch out for. Let's take a look at some of the other sectors then. Which are the sectors that are taking the lead and which are the sectors that are, really dragging the market down. I want to point out that the India VIX index, the volatility index is up 6%, back near that 14.5 level. Auto pack is holding out in the green as we speak. The energy pack is extremely flat, and so is the FMCG basket. I want to see what the IT pack is doing. That's down 0.4%. Metals, metal was among the top gainers, sectoral gainers last week. In fact, in Friday's session in a weak market, metal index was up almost 3%. Right now, some bit of selling pressure coming in. Flattish, but trading with a negative bias. Let's take a look at what the realty pack is doing. That's also fairly, fairly flat at the current juncture. Autos doing well, but rest of the market not really gaining traction at the current juncture. So of course the bias is towards the downside, but let's take a look at the individual movers then, which are the stocks that are dragging the market down. It's the metal names, these were some of the top gainers in Friday's session, now coming under selling pressure. JSW Steel, Tata Steel, these are some of the big laggards today. Power Grid not doing well. Cipla, there's some bit of news that the US FDA has classified its Bengaluru facility as voluntary action indicated. The stock is down somewhere around 1.5% at the current juncture. Dr. Reddy is also down, so the pharma pack as a whole is not doing well. Sun Pharma is another name that's not doing well. Tata Motors in the red, Titan in the red, HDFC Bank as well, and even Reliance for that matter down 0.8% or thereabouts. Which are the stocks that are providing some support on the downside? These are the likes of M&M. top gainer on the index. We have brokerage views as well. We'll take note of them, but largely brokerages are positive after the company's steady performance in the third quarter. Bharat Electronics, Bharti Airtel extending gains after good quarter. Eicher Motors ahead of numbers, it's doing well. Britannia holding out, and SBI has reversed its course among the gainers today. Kotak Bank is gaining, and HDFC Life as well after the insurance data that came out on Saturday. It's doing fairly well. Looking at the open, Nilesh, first, tell us what your recommendations are for our viewers.
Right, Nandita. So as mentioned, the focus should be on stock specific and sector specific move. So Nifty Auto Index is outperforming today. In fact, if you look at few stocks within auto space are looking strong as well. Mahindra and Mahindra, this particular stock is looking very strong. We have seen a strong rebound. The stock is almost at a new record high and looks strong for 3300 to 3350 on the upside. Can be bought at current level, keeping a stop loss below 3190. So this particular stock is looking strong. Eicher Motors is looking strong for 3600, 3700 on the upside. So few stocks that are showing strength. Auto should be in focus. We expect this kind of outperformance to continue. The major undertone looks positive. And also auto ancillary like tire stocks, Apollo Tire, where it seems like the stock has found a good base near about 410 to 400 zone. And we can expect a follow-up move to continue towards 450 to 465. With a stop loss below 421, Apollo Tire can also be bought. Another stock that is telecom stock, Bharti Airtel, where we have seen a big spurt on Friday. Today we are getting a follow-up move. So some further move towards 1720 to 1740 that cannot be ruled out. With a stop loss below 1655, Bharti Airtel can also be bought.
Okay, those are some of the recommendations coming in from Nilesh. Of course, Bharti Airtel, strong set of numbers, and M&M as well, steady performance. And, these are some of the top recommendations from Nilesh. But Nilesh, what about Oil India? Numbers came out. Last week, it saw good traction. Although on a monthly basis, it wasn't doing all that well. In fact, even the last 6 months haven't been all that great for Oil India. And the numbers are fairly weak. If you look at it, profit down 30%, revenues are also fairly flattish on a quarter-on-quarter basis. Margins have also contracted 40.7% vis-a-vis 41.6 on a quarter-on-quarter basis. Do you think last week's rebound was just a flash in the pan, or do you expect, some bit of an up move going forward? Because today, reacting to numbers, the stock is down 3%.
Right, Nandita. So if you just pull up last 6 months chart, if you can clearly see the stock has been in a downtrend after making a high near about 760 in the month of August 24. The stock has constantly witnessed a lower top and lower down formation. So structure wise, the stock is in a downtrend, and we expect further downtick to continue towards the immediate support is at 395, and below that the stock may fall further towards 365 to 360 as well. So in the previous week we saw some pullback, but looks like that pullback is getting sold into, and further downward trend towards 390, 380 that seems likely on the card. And important resistance on the upside, which is placed at 440. A breakout above 440 will give an opportunity for the stock to move towards 480 to 500. But as of now, the stock looks more sort of a sideways to me.
Okay, stock looking sideways. Before we move on to our queries, I want to quickly squeeze in your thoughts on a couple of more stocks. NHPC. Now, this stock has been sideways. If you look at the last 1 month, numbers have come out and they aren't in any way enthusing. Net profit has literally halved on a YOY basis. Revenue, however, has risen somewhere around 11.5% or so. Margins have also seen a good uptick, 45% almost vis-a-vis 36.5%. But in today's session, the stock is extremely flat, trading with a negative bias. And as I mentioned, over the last 1 month or so, it hasn't really been able to establish a trend as such. But it is just coming off its 52-week lows. Should one look at entering into this stock now?
Well, Nandita, this particular stock also has a similar structure to what we discussed about Oil India. The stock is in a downtrend, sliding from past 6-7 months after making highs about 115. The stock is constantly facing resistance on every pullback. So in the previous week also we saw a pullback towards 80. That is also a 50-day moving average for this particular counter, but not able to sustain at the high levels. So the trend is looking weak. Better to avoid, if at all, if somebody is taking any contra bet, the strict stop loss is coming around 73, because if it breaks below 73, it will be considered as a multi-month breakdown. And post that, we may see further downward momentum towards 70 or maybe 65. So as of now, it's an avoid taking any contra bet. If somebody is already holding the long position, keep a stop loss at 73, and a pullback towards 80 or 82, that if at all we see any pullback towards those levels, that can be reviewed.
Okay, that's the view. Similar structure to Oil India, sideways, so to say. And this is what Nilesh had to say about it. But what about delivery? This is another stock that has been stuck in a downtrend. In fact, hit a fresh 52-week low today as we speak. Numbers came out, although profit almost, jumped twice what it saw last year, 25 crore rupees vis-a-vis 11.5 crore rupees on a YY basis. Revenues also risen somewhere around 8.5%. But margin has contracted 4.3% vis-a-vis 5% on a YY basis. What would you do with some of these, logistics names, particularly delivery?
See, particularly delivery, the stock has been in a downtrend. We have seen a lot of underperformance in this particular counter. It is in fact trading below its important support zone that was being taken off in the previous week on Friday. That was placed at 315. So till the time it doesn't reclaim above 315, further downward tick towards 290, 280, that cannot be ruled out. So the structure is looking weak. Better avoid taking any contra bet in this particular stock, and we expect further downside momentum to continue towards 290 to 285 as well. Till the time it trades below 325, that's the recent swing high that this particular counter has made. So the structure looks weak. Only buy if at all it breaks above 325.
Okay, only buy if it breaks above 325. Crucial level to watch out for then on delivery. But let's shift focus to our queries then. A lot of them coming in this morning. I want to start off with a query on ITC from Anand Swaminath. His buy price is 465 and his holding time horizon is 1 month maximum. Wants to know whether he should hold or sell. I want to see what ITC is doing right now. Trading with mild gains, 431, that's below, in fact, his buy price is above the current price. So he's making a bit of a loss here. ITC, saw some good news, when it comes to the budget. There was nothing in terms of cigarette taxation. That way, ITC is seen as a big budget winner, and numbers were also pretty good, but brokerages have cut target after the demerger of the hotel business. The stock hasn't done much. Last week, it gave negative returns. 6-month returns are also not all that great. In fact, on a YTD basis, the stock has already shaved off 10%, and he's also making a loss here. What should he do? His time horizon is just 1 month.
Well, Nandita, the stock has corrected sharply in the previous week from the levels of 470 to almost 430 now. Good part after this correction is that the stock has reached to its crucial support zone of 420. So ideally, first thing first, one should keep a stop loss below 420, because if it breaks those levels, then the downside move towards 410 and 400, that cannot be ruled out. The stock has taken off all its short-term and long-term moving averages, and it is trading well below those levels. In the previous week, we have seen some kind of a breakdown as well. So 420 with a stop loss below the same, one can stay put. Hope that the stock may witness some pullback towards 450 to 460. Ideally, you should get out at 460 levels. If at all your view is only for 1 month, it's a good bet as a positional bet for next 6 to 8 months. But purely from a short-term point of view, we are expecting some consolidation to continue, and the range is 420 to 470. So ideally, you should get out at 460, 470 if at all we see any pullback towards those levels.
All right, Anand, hope that answers your query. The next one's coming in from Sitha Ramulu, and she wants to know your thoughts on Century Ply. This stock has been doing, fairly okayish for itself. In the last 6 months, it's given a gain of somewhere around, return of somewhere around 18%. Last 1 month as well has given positive returns. Last week was a bit quiet, but the stock is, under some bit of pressure today. 935, that's the 52-week high, and not very far, 90 odd rupees away from that. Given the fact that there was a tax cut in the budget, and Century Ply is one of the stocks that could stand to gain, given the fact that more and more people will look at home upgrades because of higher disposable income. That's one thought that a lot of experts had. So, do you think it's a good positional play now, Century Ply? In terms of upside from here?
Absolutely. So this particular stock has been in a steady outperformance where we have seen in this particular counter. The stock is witnessing a gradual up move, trading in a rising channel. So overall, the setup looks positive from a position perspective. Buy and decline should be the strategy till the time the stock is trading above its 200 MA, which is placed at 765. So that should be the stop loss. And if at all we see any dip towards 825 to 800, that can be a good entry point. And it seems like the stock is likely to witness some profit taking currently, but one should use this correction as a buying opportunity, and we expect a gradual momentum towards 950,000 or maybe 1100 kind of levels we may see in next 6 to 8 months.
Okay, hope that answers your query, but let's quickly move on to the next one then. Anil wants your thoughts on Shriram Finance for the long term. I think it's been a fairly volatile stock. Although last week it saw a good 1% kind of a return. The return on the index level was fairly muted last week. How would you approach this stock now? Would you see more upside from these 555 levels, or do you think it is expected to remain in a range-bound state?
Could you please repeat the name of the stock?
Shriram Finance.
Right. So this particular stock, we have seen some profit taking in the previous week. The stock faced resistance at its 200-day moving average. But I think it's a good bet purely from a positional perspective. The support is at 520. That should be the stop loss. Ideally, one should wait for a breakout above 580. Then only it can be bought. It's an avoided current level purely from a trading point of view. But if somebody is already holding, then one can keep a stop loss below 530 and stay put.
Okay, that's the view for the long term on Shriram Finance. But the next query coming in from Satya CK wants your thoughts on V-Guard. This stock is also not done much in the last 1 month, but 6-month returns have not been all that great, a 20% cut. But he wants to know whether to switch to Avantil for better prospects, and his time horizon is 1 year. What would you suggest?
See, Avantil, first of all, this particular stock is also in a downtrend. It's an avoid. It's not at all witnessing any, indicating any sort of a pullback. So it's an avoid. Now, coming back to V-Guard, this particular stock is comparatively looking better, but ideally one should have a positional view on this particular counter. With a stop loss below 360, one can stay put. Any pullback towards 420, 430, if at all we see, then one should review this particular stock, or ideally, book profit if at all it comes in the range of 440 to 450.
Okay, that's the view. Hope this helps you. Next on the horizon, in fact, next on our feed is a query from Naveen. He wants to know your thoughts on Canara Bank for swing trade. I remember you, just a few minutes ago, you said that, it's better to look at private banks compared to PSU banks right now. But when it comes to swing trading, would you suggest looking at a Canara Bank?
No, it's again an avoid. As I mentioned, PSU banks are not looked at current level for any sort of a pullback because the structure is looking weak. So better to focus on private sector bank for the time being. Till the time we don't see any reversal, pattern, it's an avoid. So even in Can Bank, if somebody is already holding the long position, then keep a stop loss below 90 and wait for a pullback towards 95, 98 that can be used as an exit opportunity.
Okay, that's a view on a Canara Bank. But next query I spotted on a K FinTech from Mani Kandan wants to know what should be done with the stock. Now, this stock had a fairly good run last week. I think it saw gains of somewhere around 9% or so. Today, again, it's under selling pressure, 3.5% down. But would you consider this stock as a buy on dip opportunity?
Yes, absolutely. The structure is looking positive and we have seen a good correction. Now, again, we are witnessing a rebound. I think from a positional perspective, it's a good buy. Keep a stop loss below 1050. And on the upside, we may see a pullback towards 1300 to 1400.
Okay, 1300 to 1400. That's the upside target on a KFin Tech. Hope that answers your query. Shifting focus to the next one then. This one is coming in on a CG Power. This stock is also not, seen any fireworks. Look at the last 1 month, negative. Even the last 6-month chart is throwing up negative, trend. 600, it's although managed to come off pretty well from 52-week lows, but still some time away from highs. How should one approach this particular stock?
See, again, the structure is looking weak from a short to medium term point of view. Pullbacks are getting sold into. We can expect further downtick towards 560, 550. So better to avoid taking any contra bet, and the resistance at 650. I would be, advised to buy only above 650 as of now. It's an avoid.
All right. Just want to squeeze in a couple of more queries before calling it a day with Nilesh. Nilesh, I spotted a query on Inox India from Alex. He wants to know how one should approach the stock from a long-term perspective. At current levels, any thoughts on this particular stock?
Inox Wind or Inox India, which stock you're talking about?
Inox India.
Okay, Inox India, which is currently at 966. It has a sort of a limited data. It got listed in the year 2023. So whatever data I have, it looks like more sort of a topping out formation and not looking attractive at current level. Resistance is at 1050 and support is at 900. So that's the broader 150 point trading range. So no clear trend as of now, so better to avoid.
Okay, better to avoid Inox India. Hope that answers your query. Last one then. Roshan Sharma wants to know whether he should consider Maruti Suzuki for the long term. I know from the auto pack, M&M is one of your top picks, but what about Maruti Suzuki?
See, Maruti also has a very strong structure. It has been in an uptrend recently, but purely from a long-term perspective, it's a good buy on decline, buy in a staggered manner, buy in multiple tranches, because some profit taking at current level that cannot be ruled out. But it's a very good bet. It has a potential to test 15,000 kind of level positionally. So with a stop loss below 12,000, buy on decline should be the strategy.
Okay, buy on declines. That should be the strategy on a Maruti. With that, we've come to the end of the query segment. If we couldn't take up your query, don't get disheartened. Keep them coming in. Send it to us tomorrow. We'll try and take them up. But Nilesh would like to thank you for helping us navigate the market to understand the direction where we are headed, and of course helping our viewers as well navigate their stock related queries as well. Hope you have a great day, and I look forward to connecting again with you sometime soon.
Thank you, Nandita. Thank you for having me on your channel.
Thank you. On that note, quickly take a look at the market then. It is in fact 120 point cut on the index as we speak. So yes, the weakness has only intensified, 0.5% lower on the index level, but the pain in the broader market is back because mid-cap index has slumped over 1% or so. It's a 550 point cut on the mid-cap index. The breadth is also very poor. 635 advances to 1724 declines on the NSE. So the ratio is almost 1:3. That's the kind of breadth that we are witnessing. So some bit of pain when it comes to portfolios. And in terms of, the major laggards, we are looking at some of the metal names. Of course, there's a whole tariff threat looming from Trump, and that is weighing in on the metal pack. In fact, even OMCs are not doing well despite some bit of comfort from the fact that crude or Brent crude is trading sub 75 levels. But yes, pharma and metals, these are the top laggards. These, by the way, were the top gainers for the entire last week. But on that note, let me bring on board our next guest for today. Joining me is Kunal Valia of StatLane. Kunal, great to have you on the show. It's been a long time since I spoke to you. But a lot has happened since then, right? We've had like a few big events. We had budget, that came as a positive surprise in terms of taxation. We had the RBI handing in a 25 basis point rate cut, that too after a gap of 5 years. And we also had the Delhi election results that from a market standpoint is looking positive. But we had the whole tariff thing weighing in as well across the global markets, and our markets aren't really insulated so far. So your thoughts as to how or where we are headed from here, what are your thoughts in terms of the current context when it comes to the market direction?
Good morning, Nandita. Thank you for having me on the show. Indian markets are stuck after a long time in something what we call is getting the macros right. So we had this stupendous rally in Indian equities for last 3.5 years, where almost everything moved up either simultaneously or sequentially. Indian markets, both equities, bonds, for the year 2025 and largely the first half of 2025 will be influenced largely by global and domestic macros. Talking of globally, I think it will be more about the Trump policies and the Federal Reserve that will be at the center stage for markets. We have seen that since October of last year, the dollar moving up, the Fed changing its stance between October and December. So I think they are going to be at the center stage for markets, whether it is India or any of the other emerging markets. What we are expecting a scenario is a very flattish global growth. US is likely to do reasonably well in terms of the GDP growth outlook relative to other advanced economies. And as a result of which, what is visible is divergence in monetary policy between US and Europe. We don't see that often. In fact, over the last 10, 15 years, we have not seen such a divergence in monetary policy between US and Europe. If you look at 6-month forward rates between US and Europe, both are moving in different direction. Europe is cutting rates in haste because they feel the growth is not there at all. Because we saw in 2024, both France and Germany, which are larger parts of European economy, not doing anything in terms of the GDP output, pretty flat. Whereas US has delivered roughly 2.5%, 3% growth in 2024. That is visible in the implied monetary policy rates, as I mentioned, that both are moving in opposite direction. Since US economy is reasonably on a distinct footing, I would say reasonably stronger footing compared to some of the other advanced economies, we saw a very, very drastic shift in stance of the Federal Reserve. In October, Federal Reserve mentioned that there will be 4 rate cuts going into 2025, and coming into December policy, they rolled back from 4 rate cuts to 2 rate cuts. And actually the markets didn't took it well. What happens when US is on a reasonably strong footing? Typically, Fed will be very, very measured in terms of the rate cuts which they are likely to give. And what impacts emerging markets, including India, is that if the US is not going to bring down rates in a haste, it will mean that emerging markets, including India, will have a shallower rate cut cycle. Coming to India, as you rightly mentioned, Indian budget, the union budget, has offered a very, very strong consumption-led growth while maintaining the capex momentum. People are talking about, hardly any growth in capex, etc. But I think a 10% growth over the revised estimate has been there in the budget. Plus, they are pushing the states to drive the capex as well. So if we have to look at the grants which is being given to states to drive capex, the growth is very, very reasonable and the momentum is alive for capital goods companies, infra companies as well.
So would you say that the valuations for Sure. I mean, so would you say that the valuations for capex and infra-related themes are looking reasonable after the correction that we have seen over the last few months? And since there has been a 10% increase in capex as well, should one look at the capex as a theme, or should one look at consumption given the tax boost?
Right. So we are in a market which is like a test match kind of a market. So the returns which investors are used to between 2021 and 2024, where you invest in something and you are able to make money, it's not going to take place at least in 2025, at least for the first half. It will be more about accumulating those stocks in the first half of 2025, and possibly second half of 2025 will be rewarding investors if they are picking the stocks in a more disciplined manner. So valuations are not comforting in certain areas, but yes, after the correction, they have become a little bit more, I would say, coming back to their senses compared to what it was in 2024. What I was mentioning is that the consumption boost of almost 1 lakh crore, which has come through the tax relief, then it will be in the form of extra consumption, which will come into the market, or it will be a combination of consumption and deposit growth, or savings, we should call it. So that is going to be, reasonably good for the markets overall. The fiscal consolidation, Nandita, if you remember, in 2021 peak, the fiscal deficit of India reached 9.2% because of the COVID related. And I'm talking only about the center's fiscal deficit. The fiscal consolidation has taken place, I think, in a very disciplined manner. The finance minister has done a great job in bringing down that number to almost 4.4% budgeted for FY26. I think this is very commendable and very, very important from a macro standpoint, where we are seeing a lot of things which are moving up and down in the global markets because of what US is doing. That's on the fiscal side. On the monetary side, we had another pivot last week. RBI has been facing a very difficult trifecta challenge of growth versus inflation dynamics versus the currency management. And as you know, the US dollar has moved up almost 8-9% post Donald Trump coming back, and that has led to a lot of flutters in the market in terms of the currency management. RBI is making substantial efforts by infusing liquidity, whether it is CRR cut and whether it is doing repos and so on and so forth. And after this rate cut, it is now very, very clear for us, both fiscally and monetarily, we have a very positive pivot towards supporting growth. So I think if we are patient enough, this market is giving us good opportunities to accumulate good stocks, and possibly we need to sit on those stocks for a while before we get the returns and the fruits out of it.
Sure. Kunal, you mentioned that the era of easy money may be behind us for now. Any themes which are evergreen and which are agnostic to really all the happenings around tariff, etc., which one should look at purely from a capital protection standpoint?
Right. So the external facing sectors, Nandita, will always be up and down for the year, because we have seen what is happening in US. One day they are announcing that the tariffs are coming through, and next day there is some kind of a negotiation which is coming through. So we understand it's a business tactic and a negotiation which will take place at least for next 3-6 months with different countries. So if you want to avoid external facing sectors, I think domestic oriented sectors, especially we like private and PSU banks. There has been a significant correction in PSU banks in last 6 to 9 months, whereas the private banks, largely the quality names, has not done anything for last 3.5 years. So that is one place. I think a combination of private banks and PSU banks should be a good place to invest in over the next few months. That's what we feel.
Right. What about the quick commerce space? This space has been heating up, and how? Recently we saw what happened with Swiggy. The numbers came out, and we saw some bit of margin pressure because of their expansion plans when it comes to the quick commerce segment. Is there an investment case when it comes to names like Zomato and Swiggy, given the fact that they could be staring at cash burn, when it comes to expansion, and we also have Zepto, it could enter the market sometime soon. So do you see an investment case right now, or would you say that, steer clear because things are really, heating up and margins could, be heading lower from here?
Sure. So Nandita, the color of the market right now is different than what we are used to in last 3 years. So market wants to go for companies which are strong in terms of their revenue and profit growth. Profit matters right now to the market so much more than what possible growth would be. So the color of the market is more towards very, very strong balance sheets and profit-making entities compared to, thinking about growth, high growth companies right now. So we need to be cognizant of the fact that we need to be in line with what is the color of the market right now. It's very, I would say, if you look at the overall economic situation, the forex reserves has been coming down at a drastic pace because of the rupee depreciation. So there are, larger macro factors at play, which one needs to be cognizant about. So if you want to invest in equities, we would prefer to go with profit-making companies, which has a strong track record of delivery to investors over many, many years, rather than, chasing growth right now. Yes, obviously, another 10, 15, 20% correction in that kind of stocks which are promising superior growth compared to the standard ones. At that point in time, we will be happy to look at those companies as well.
Last question really, Kunal, in terms of autos, what are your thoughts? Do you expect increased consumption post the tax cuts? And there's another view to it that EV scale up is happening at a faster pace now, and a lot of companies will be spending more on that front as well. Could that weigh in on margins here as well? Autos have seen a good outperformance, but recently we've seen sell-off coming in there as well. So your thoughts on how autos are expected to fare going forward?
I think we are bullish on two-wheelers as a segment. Passenger vehicles is also going to do well as the government spending in terms of capex comes back, which was little lower side last year because of election and delays in capital spending by the center. I think it is going to come back in a rush. I think in next 2 quarters, and that will lead to coming above growth in commercial vehicles as well. So autos as a segment, we would be very comfortable looking into at this point in time.
Okay, and lastly, since we were talking about rupee as well, in fact, rupee has hit 88 vis-a-vis the dollar, fresh record low. Which are the export-oriented themes you would look at in light of this?
IT is one sector which has moved reasonably well. Pharma will continue to do well, but we need to be cognizant of a fact. Nandita, if you would have seen in the month of Jan, a defensive unit like pharma was down 8%. It tells us something that, the larger part of the pharma story in terms of the valuation expansion is over. Now it will be more about the earnings growth, and market will be focused more on earnings from those companies rather than re-rating of the multiple. So pharma is good, but I think IT is a very good space to look into, and some of the other export-oriented units like auto, which you said. So we would rather stick to auto and IT right now. Pharma is looking a little expensive relative to what it has been in the past. And given already the Upmove for last 2.5 years, I think there's a little bit of more value which can come through in pharma for us to become very positive on that sector.
Sure, point taken, Kunal. With that, I'm afraid we are running out of time, but had a good chat with you. And I wish to touch base again sometime soon, but would like to thank you for taking out time. Appreciate your coming on our show today.
Thank you, Nandita. Have a good day.
You too. Well, 23,420, that's where we are at when it comes to the Nifty, down 0.6%, but 23,400, remember, will be a crucial level to watch out for. Of course, 20 DMA, that level is crucial, and if that gets taken out on the downside, who knows, we can even look at testing 23,300 or thereabouts. So yes, not looking all that great, haven't really started the week on a great note. The mid-cap index is down in excess of 1%, and the breadth is not looking encouraging at all. The advanced decline ratio on the NSE is now 1:3.5. So yes, there is pain, and it's quite visible at the current juncture. But with that, completely timed out on this edition of Opening Bell. Thanks a lot for tuning in. Have a good day, and I'll see you again at 3:30 p.m. with Closing Bell. See you soon.